the dominant fundamental that we have in the world today that we're talking about in equity markets and interest rate markets is what in the world is the Fed doing and how are they doing it? So I'd like to have you speak to that chart if you would.
Yeah, so obviously the Fed has been forced to resort to kind of a shock therapy, if you will, to try to break the inflation fever, for the lack of a better term. 6 months ago, before the Fed turned really hawkish, the expectation was kind of that the Fed, obviously it lowered rates to zero during the pandemic. It started an asset purchase program of $120 billion a month. And as the crisis passed, at least economically speaking, but I think in most ways the crisis has passed or is passing, the need was, or the justification was just no longer there to have a policy that was that accommodative. And before December, when we had that FOMC meeting in December, where the Fed really started to turn it up a notch and to change expectations, I think the thinking was the Fed would do like a 2015, 2016 tightening cycle, easy, gradual, quarter point per meeting until it got to neutral, which at that point was considered 2 to 2.5%. Then, of course, inflation ended up becoming a much bigger problem than expected. It was considered to be transitory, at least in the eyes of the Fed, and then it turned out to be much more persistent. And then we had the Russia-Ukraine conflict, which again amped up the inflation measure a couple of notches as well. And so as a result, the Fed has had to really go into warp speed, if you will. And so what started as a very gradual curve from 0 to 2 over the span of 2, 3, 4 years, all of a sudden is a very rapid move past neutral to about 3.25%, 3.5%, which is not, by historical standards, not that far above neutral. Historically, when the Fed has been tightening policy, it's gone 200 to 300 basis points above neutral, which would put us at around 4 or 5%. We're not there, at least not yet. But the Fed has been moving the goalposts and has been moving much, much faster. And that's been a shock to the system, of course. You look at the bond market, it's probably the worst bear market I think we've ever had at this point. The 10-year yield was 1% last year. It knocked on the door of 3% last week. It's down to 2.75% today. And the stock market, is getting the message as well. When the Fed is tightening policy, it needs to tighten financial conditions. That is the transmission mechanism for tightening the financial economy, which from there will presumably slow down demand in the real economy. And so the financial conditions index is an index that I follow very closely. And the stock market is part of that index, as are interest rates, credit spreads, and the dollar. And the only market that wasn't really paying attention to what the Fed was shouting out loud, which is we're going to raise the cost of capital for everyone, was the stock market. The stock market fell right after Russia invaded the Ukraine, and then it bottomed and started to recover. Now the stock market is paying attention, as it should, because when interest rates rise, it has an impact on the stock market, right? Because the way we look at valuation in the stock market is you look at the expected cash flow or earnings growth, and then you calculate a present value of that. And the higher the interest rate or the cost of capital goes, the lower the present value is of those future cash flows, all else being equal. And of course, earnings provide an important offset, and earnings growth is pretty strong right now. It's expected to be 11% this year. But price is kind of at the intersection of a PE derating, which generally happens when the Fed is reducing liquidity, as it is now, and earnings growth, which typically happens when the economy is strong, as it is now. And then price is at the intersection of those two. And what the stock market is doing, what the bond market is doing, is trying to figure out where this cycle is going, where and when it's going to end, and what the collateral damage, if anything, is from the Fed raising rates from nothing to potentially 3 or 4%. And we're in that price discovery mode right now.
Let me ask you a question on price discovery. Um, my best trade last year as a prop firm was being short Treasury futures. And that started in January of really Q1 2021. Then the market kind of stabilized. And then starting in Q3, August 21, we had another big spurt up in yields, down in price. And again, it was a great trade for us from a prop trading standpoint. And so we're, as a prop firm, doing really well betting on higher yields. And at the same time, the Fed it felt to us traders like the Fed was way, way behind the curve. And I just remember back in the 80s, oftentimes the Fed leading the parade, right? I mean, the Fed would come in with shock and awe, and and it would turn the market, and it would surprise traders. Where here, the traders that I knew were way ahead of the Fed, talking as early as December of last year about 10 years going to 3.5%, and the Fed still, dragging along the gutter with Fed funds rate. How do you read that? What in the world was that all about?
Yeah, the cycle is a little upside down, it seems, but maybe not as much as it appears. But to your point, prior to the financial crisis, the Fed was not transparent, right? And my favorite example is the Greenspan Fed during the 1994 tightening cycle. I remember it very, very well. There were no dots. There were no, I don't think there were any minutes, at least they were not published. Nobody really made speeches. And as you probably know, Greenspan famously said that if you think you understood what I just said, then I wasn't expressing myself very well, or something, to that effect. And so, I have a chart of the 94 cycle, and I look at the forward curve at after every tightening that the Fed did. Remember, Greenspan started in February of 94 out of the blue at 3%. He hiked rates 300 basis points in 50 basis point increments, even in 75 basis point increments. All that stuff was unheard of these days prior to this particular cycle. And then Greenspan just stopped in November of 94 at 6%, and then he cut rates in 1995. It was a preemptive strike against inflation, and it worked. It's one of the very few, if not the only, soft landing that a full Fed cycle has ever produced. But the market was always offside, so it never knew what was coming. So every time the Fed tightened, the forward curve would ratchet up even further. And it was always steep, but it would just go up because the market really didn't know what was coming until the very end, when it over expected, and then all of a sudden Greenspan, took his foot off the brakes. During the financial crisis, I think the Bernanke Fed probably rightly realized that forward guidance is an important tool. Like you can create a policy without really having to do much other than talk. And that's, the dot plot came out in 2012. And from that point on, the markets basically did most of the work for the Fed. And so right now we're in kind of this unusual position where the Fed has only raised rates once so far, and that was, in March. But the bond market is way, way ahead of the Fed. But in a way, the bond market is just doing the Fed's heavy lifting. And if you think about it, that actually makes a lot of sense because, after all, what is the one rate that the Fed actually sets? It's the overnight Fed funds rate. Well, that's a rate that banks use to lend and borrow against each other. But who even uses that rate anymore, right? There are so many reserves in the system that the banks can manage that through repos and through other methods. So I don't know that the Fed funds rate is even really a rate that is actively used. And therefore, it's probably not an efficient transmission mechanism for policy other than a symbolic guide to then lead the rest of the market. So the 10-year yield, which obviously you did a great job shorting a year ago, went to 298 last week, and the 5-year yield is around 2.5. It was a little higher last week. So the bond market is doing the work, and all the Fed now has to do is just to follow through on what the bond market has already done. And that's why, all of this The speculation about will the Fed go 50 next week when it meets, it likely will, but will it do 50 again after that, or 75, or this and that? To me, that doesn't really matter. What matters is the terminal point of the cycle, which right now is around 3.25 in about a year. How we get there, to me, is not really that important because the bond market is already there anyway, and that's where the real transmission happens.
Yeah, I know in the chart that that Real Vision has showed here, the Fed and the market, it shows SOFR, which is kind of a blended rate, right? Moving on up to 3.3 area, but then it kind of concaves, right? You have your estimate in the markets, price discovery has the market then concaving down with yields coming back to 2.7, leveling off, then kind of a little bit of a ramp up as you go further than that. My sense, and it's just maybe my sense as kind of a speculator, is that would surprise the market. I know that's where it's priced, but at least the people that I tend to hear, which oftentimes are the noisiest, really are looking for rates to continue much higher than that. And you're really looking at what's happening using 1994 as an analog. And speak to that. I'm fascinated with analog, your research, and analog, your comparisons. So speak to that briefly, if you would.
So the SOFR curve, which is like the new LIBOR, basically, it has a kink in it, right? So it was very gradual. 6 months ago, the market just expected a very gradualist return to neutral or even below neutral, but in a kind of a straight line to where the terminal dots are, or the long-term dots are on the dot plot. Now the market realizes, probably correctly, that the Fed is not going to break the inflation fever by doing that. So it has to go beyond neutral. Again, neutral, I think, is generally considered at 2.5%. R star is 0.5%. That's a real rate. And then you add the Fed's 2% inflation target, you get to 2.5. So that's generally the perception of neutral. So the market, I think, correctly anticipates that the Fed needs to go into a full-on proper tightening mode, which means it has to bring rates above neutral. The question is how far above that. That's a moving target that is moving literally on a daily basis, right? I mean, that 3.3% that we have now, and again, that's the market. That's not me saying that's what the Fed's going to do, but that's what the market is saying. That 3.3 was 3 maybe 2 weeks ago, and it was 2.75 a month ago. So it's a moving target. But what I think the market is saying is that in kind of the glass half full scenario, this will be like a Greenspan cycle in 1994. Greenspan went up 300 and down 75 because he declared victory. The preemptive strike was successful. The Fed is hardly preemptive this time, of course. It's highly reactive to a persistent inflation problem. But the glass half full interpretation is that the Fed will achieve its goal of breaking the inflation fever by going to 100 basis points above neutral or thereabouts. And then once that dragon has been slayed, it can go back to neutral, basically. And that curve, that concave curve, ends up at neutral after going above neutral. So that would be the best case scenario. The Fed beats inflation, it goes to neutral, because ultimately neutral is neutral, so that's where the Fed should eventually end up. The glass half empty, of course, view would be that the Fed has to shock the system so hard to break inflation that it will break something in the economy, that there will be collateral damage in terms of a recession, right? I mean, and the yield curve very briefly inverted a few weeks ago. It's uninverted since, but it's flattening again as we speak. So the glass half empty view would be that the Fed's going to break something, and that will force the Fed to then start easing again. But it's interesting that that kink in the curve, a month ago, the market expected the Fed to go up and then down 100 basis points from there. Today, it's up more and then down less after that. So that concave is becoming less concave. And so the market is kind of pricing in that maybe the Fed needs to stay up there longer in order to break inflation. And maybe that's what we're seeing play out in the financial markets. That I think the stock market was kind of in a state of suspended animation a few weeks ago, saying, the Fed will go tight, but it's not going to stay there very long, and then it will ease off. And when we put that into the discounted cash flow model over a 5-year horizon, we're fine. But if that backdrop changes to they're going to go tight and they're going to stay tight, that's a different backdrop. So maybe the market is coming to terms with that.
It's a really complicated world out there. We've got massive inflation, recession fears, war in Europe, COVID, China issues. What the hell's happening? Everyone's got an opinion, but who's right, who's wrong? As co-founder of Real Vision, I've got my own view, but maybe I'm wrong too. And I want to go and find out more from real experts, real in-depth analysis. And I've hand-chosen my experts for this 2-week journey of discovery in global recession. Is everyone wrong? I've chosen people like Peter Zeihan to talk to them about geopolitics, David Rosenberg about the economy, and Pierre Andran, the world's most famous energy trader, about how to navigate the oil markets and where it's all going. This starts on May the 2nd, and I'm going to learn so much about what really is going on and how to best navigate it. Yes, not everybody's going to be saying the same thing, but it's going to allow me to piece together an investment framework to navigate these complicated times. Now, normally we'd give you a 7-day trial for $1, but because this is so important for all of you, and I think it's one of the most important pieces of content we've ever done, we're extending that free trial for 2 weeks for $1. So you get the entire campaign of all of these great minds. And it's only $1 for all of this. So just go to realvision.com/global recession to find out more and join me as I try and figure out what the hell's going on.